Hello, my name is Robert Reilly, and this is the quick tip of the week. And this quick tip relates to ESOP, employer stock valuations. And today we're going to talk about the differences between an ESOP fair market value valuation and a sponsor company transaction fairness opinion. And specifically, these are the topics we're going to talk about. And the first is the various ways in which an ESOP sponsor company, or specifically an ESOP trustee, may use the fair market value valuation, what we might normally think of as the periodic or annual employer stock appraisal. And we're going to contrast that with how the sponsor company or the trustee will use a transaction fairness opinion. We're going to consider when each type of opinion is appropriate. We're going to consider which parties rely on each type of opinion. We're going to consider the differences in the content and the intent of each type of opinion. And most importantly, for us as valuation analysts, we're going to consider the differences in the level of risk that we assume and the level of responsibility that we assume when we're performing one type of service, the annual employer stock appraisal, as compared to another type of service, a transaction fairness opinion in the ESOP-owned sponsor company. Now, we know that under ERISA, an ESOP cannot pay more than what's called adequate consideration for the employer corporation stock. And we know that under ERISA, an ESOP cannot receive less than adequate consideration when it sells its employer corporation stock. Adequate consideration is the actual term that's used in the actual act of the law, ERISA. Now, the Department of Labor regulations define adequate consideration, and adequate consideration is defined as fair market value as determined in good faith by a plan trustee. Part of that definition applies to us, part of it doesn't. We conclude fair market value. We as valuation analysts, we conclude fair market value. We don't conclude adequate consideration. Adequate consideration is fair market value, but as determined in good faith by a plan trustee. We're not plan trustees, and while presumably we generally have good faith means, there's a very specific legal definition for that, and that gives you a fiduciary obligation to the ESOP plan participants that as a plan trustee you do have, as a valuation analyst you don't want to have. So remember what our assignment is. Our assignment is to conclude fair market value and recommend that to the trustee. The trustee then applies good faith and judgment and concludes what adequate consideration is, and then the trustee will not pay more than adequate consideration for sponsor company stock, or not accept less than adequate consideration when the plan sells sponsor company stock. This is why, again, because we're advising the trustee, this is why when you prepare your employer stock valuation, you should actually address it to the plan trustee as the client. It's easy to make the mistake to say, well, the sponsor company is actually paying me, so I should address this to the sponsor company. Well, don't. While the sponsor company may pay your invoice, and typically does, it's the ESOP trustee, whether it's an inside trustee or, meaning an employee trustee or an outside or independent trustee, either way, it's the trustee who's actually your client. Now, how does a sponsor company use the fair market value stock appraisal that we provide? Well, the sponsor company uses the employer stock appraisal to claim an income tax deduction when the company contributes shares to the plan. So when the company contributes 1,000 shares, 10,000 shares to the plan, they multiply that by the fair market value. That's the amount of the tax deduction that the employer corporation takes. So obviously our fair market value conclusion is important there. The sponsor company may use our fair market value conclusion to conclude how many shares to contribute to the plan, because there are a number of limitations on how much a company can contribute to the plan each year. There are annual payroll, and those limitations are based on the annual payroll of the company. They're also based on the loan repayment requirements for companies that have a stock acquisition loan, an ESOP stock acquisition loan. But the point is, let's say that the company has a $5 million contribution this year. They can make or want to make a $5 million contribution because that's the payroll limitation, or that's the amount of the loan requirement. Well, all they know is they need to contribute $5 million. We then tell them what the fair market value per share is, and that determines how many shares they contribute to the company. So that's another way that you will use our fair market value conclusion. The plan administrator, who's typically not the trustee, the plan administrator will use the fair market value that we conclude to allocate shares to the plan participant accounts as the ESOP loan is repaid. So as the ESOP stock acquisition loan is repaid and the plan ESOP shares go out of suspense and into each employee's account, that's based on the fair market value that we conclude. The plan administrator, who again is not the trustee, typically uses our fair market value conclusion when retiring employees come and put their stock back to the company. They need to get cash, and the cash is based on the number of shares that they put back based on our fair market value. Or when over 55-year-old employees request diversification of their account balances, that's going to be based on the fair market value per share that we conclude. The plan trustee, now this is a different party, the plan trustee uses our fair market value conclusion to himself or herself conclude adequate consideration when the ESOP trust either buys employer stock or sells employer stock. So this is how when we perform an annual ESOP fair market value appraisal, this is how our work product is used. Now, what happens, and that, as you know, is at least an annual process as required by ERISA. Some companies ask for quarterly or semi-annual ESOP valuations as well, but the minimum requirement is an annual ESOP stock valuation. Other than the annual ESOP stock valuation, if the sponsor company is involved in the transaction, the ESOP trustee may very likely request, and it is very commonly will request, a fairness opinion from you, the valuation analyst. And this will happen on a number of specified occasions. The first, of course, is when the ESOP is first formed, and the ESOP plan itself buys the stock from the employer corporation for the very first time. So the initial purchase of employer stock, in that instance, the ESOP trustee will almost always ask for a fairness opinion. Any subsequent purchases of employer stock, if the ESOP purchased 30% of the employer stock initially, and then 20% a year after that, and 20% a year after that, and 20% a year after that, well, those subsequent purchases may require a fairness opinion. If an outside party comes and makes a tender offer to buy the employer corporation, obviously that means also buying the stock inside the ESOP trust. The ESOP trustee will ask for a fairness opinion. And when the sponsor company recapitalizes and performs a debt for equity swap or an equity for debt swap, then in those cases the ESOP trustee will very frequently ask for a fairness opinion. Now, what's involved in a fairness opinion? The fairness opinion includes some specific topics and opinions that the annual ESOP valuation doesn't include. In the fairness opinion, you're going to be asked to opine on whether the price that was paid or received for the employer stock is fair to the ESOP, number one. Number two, you're going to be asked, are the terms of the transaction fair to the ESOP? That's called the absolute fairness test. Separately, you're going to be asked, are the terms of the transaction as fair to the ESOP as they are to any other party in the transaction? And that's called the relative fairness test. You're also going to be asked to opine on, are the interest rates on any debt related to the transaction current market interest rates, or are they over market or overstated or inflated interest rates? Now, all of these opinions are going to be provided from a financial perspective. You're only going to be asked to opine on these topics from a financial perspective, certainly not from a legal perspective. but you will be asked to opine on these specific topics from a financial perspective, and that's not uncommon at all in a sponsor company transaction. Now, in the case of the annual employer stock valuation, again, that's required by ERISA, and what you conclude is the fair market value of the employer stock on a specific date, typically the plan's fiscal year end. Those annual stock valuations are used for various administrative and tax purposes, as we talked about. Those annual stock valuations are addressed to the plan trustee, and because of these factors, we're really not opining on anything other than fair market value. Any decision that's made related to the ESOP stock is made by the trustee after the trustee incorporates our valuation. We have relatively little risk and relatively little responsibility. Obviously, we have to act professionally, but we have relatively little legal responsibility. Now things change. In the case of a fairness opinion relates to an ESOP trust purchase or sale of the employer stock. Money is changing hands now based on our opinion. When the valuation analyst provides a financial opinion to the trustee, you're going to be asked to opine on several specific aspects of the actual planned transaction. And the trustee will make his or her decision based on your recommendation. Therefore, the valuation analyst assumes a lot greater responsibility with respect to issuing a fairness opinion than with respect to issuing the typical annual ESOP employer stock appraisal. In both cases, I should mention here, we'd also want to address the fairness opinion to the plan trustee and make sure that the plan trustee and only the plan trustee relies on the fairness opinion, that you don't have someone else like a financial institution or a founding family member or some other minority stockholder relying on your fairness opinion that's directed to the plan trustee. Finally, the valuation analyst, you and I, should understand which type of opinion the ESOP trustee is requesting and how the opinion will be used. So when the client comes to you and says, okay, I want an ESOP stock appraisal, make sure you understand that's all you want. I can give that to you, and that's the opinion that you asked for, and that's the opinion I'm going to give to you. If the client, who's, again, the ESOP trustee, really wants a fairness opinion, you should know that up front, because the work you're going to do is a lot more comprehensive, and the liability you're going to assume is a lot greater in the case of a fairness opinion than an annual ESOP stock appraisal. You'd want to know that up front and prepare your time budget accordingly and prepare your fee budget accordingly as well. So that concludes the tip of the week related to ESOP employer stock valuations. Thank you for your time and interest, and good luck to you in preparing your ESOP stock valuations and ESOP fairness opinions.